Most of us are pretty good at knowing whether we're getting value for money. We compare prices, we read reviews, we shop around. But when it comes to investing, it's a completely different story. The fees you pay are often hidden, hard to compare and easy to ignore. And yet they could be the single biggest drag on your long-term returns. David Jones spent years as a financial planner before joining the fund management firm Dimensional Fund Advisors. He says most people are good at judging value in everyday life, but financial services are a different matter entirely.
They know the price of cornflakes or they know the price of a haircut. And they'll know that, if they go to one barber, it'll be a cheap haircut. If they go to the fancy salon, they expect to pay more for it. There's a way that they can deal with the tangible and they can assess value. And the challenge arises when you don't have enough information or experience to know how do I actually equate what value for money is in the context of either investment returns or the service delivered by the financial advisor, part of which is delivering an investment program, but the other part of it is dealing with tax. The other part of it is helping out in all sorts of different ways. So it is very, very challenging.
It's an important point. There's a difference between the fees you pay for financial advice, which can add real value, and the fees buried inside the investment products themselves. Most people lump those two things together, but that's a real blind spot. Because even a small difference in investment fees, 0.5%, say, compounds year after year. Over a 20 or 30-year horizon, the impact can be enormous. David, who's a part-time rowing coach, has a good analogy for this from his favourite sport.
If I was to say to the rowers, well, this loose piece of webbing that you've left on the boat is dragging along and it's slowing you down, let's say by that much every stroke. Every time you strike a stroke, it slows you down by that much. And you go, well, that's not very much. Yeah, but multiply that over the 250 strokes you're going to take in the course of the race. That times 250. And that's not even exponential. So you go, oh, that's going to be a huge difference, isn't it? So you go, right. So now we have to really focus on minimizing the frictions because multiplied over and compounded over time, they add up to huge amounts.
It's a vivid image. Tiny frictions, barely noticeable in the moment, adding up to a huge difference over time. That's exactly what investment fees do. But here's what's really striking. Many investors assume that paying higher fees at least buys them a better fund manager, someone with genuine skill. But outperformance is often down to luck.
There's not a lot of evidence to suggest that it's reliably due to skill. And it's in large part, you got lucky. Now, is there a really big incentive for managers to say, hey, guess what, pay me more because I'm really lucky? I don't think that generally works. So, and the other thing is say, well, if they genuinely did have that skill, do you think it's going to be available to you, Mr. General Public Event, or do you think they'll not be doing it for sort of, 2 and 20 or 3 and 30 in their hedge fund and commanding considerably more fees? So I think that those people who seem to have had some significant edge for whatever reason have generally been not accessible to the average investor. So irrelevant as far as most clients of most advisors is concerned.
It's a sobering thought. The skill that would justify higher fees is rare, and even where it does exist, it's not available to ordinary investors. So fees matter more than most people think. They're hard to see, they compound relentlessly, and paying more doesn't mean getting more. If you're not sure what you're paying or whether you're getting the returns you deserve for the risk you're taking, it's well worth having that conversation with a financial planner.